Financial markets survive crises repeatedly. Banks fail, bubbles burst, governments intervene, regulations change, and yet over time similar patterns return. Leverage expands, risk concentrates, liquidity becomes abundant, confidence grows. Then the cycle repeats. Modern finance often presents crises as isolated mistakes, the result of poor decisions, weak oversight, or unexpected shocks. But what if instability is not an accident? What if financial systems naturally drift toward fragility during periods of stability? This is the story of why markets rarely fix themselves permanently, and why each crisis may solve one vulnerability while creating another. Markets are adaptive systems. Participants continuously respond to incentives, regulations, and changing economic conditions. When rules tighten in one area, activity often migrates elsewhere. After the global financial crisis, banks faced stricter capital requirements and oversight. In response, parts of the credit system shifted toward private markets and shadow banking structures. When leverage becomes expensive, financial engineering seeks alternative forms of efficiency. This process is not necessarily malicious. It reflects competition, innovation, and the pursuit of return. Over time, successful strategies attract more capital. Risk appears manageable because conditions remain stable. The longer stability persists, the more participants begin assuming it will continue. This dynamic can gradually weaken resilience even as systems appear safer on the surface. Modern financial systems promise progress through reform. After crises, policymakers introduce new regulations designed to reduce systemic risk. Capital requirements increase, transparency improves, oversight expands, markets adjust accordingly. The promise is that lessons are learned. Technology and financial innovation reinforce this belief. Better data, faster communication, and more sophisticated models suggest that future instability can be identified earlier and managed more effectively. Central banks also play a stabilizing role by providing liquidity during periods of stress. Together, these mechanisms create the impression that financial systems evolve toward greater resilience over time. And in some ways, they do. But adaptation changes behavior. When participants believe systems are safer, they may accept higher leverage, tighter margins, and more complex exposures. Stability can therefore encourage the conditions that eventually undermine it. Periods following major crises often produce long expansions. Confidence returns gradually. Credit becomes available. Asset prices recover. New financial structures emerge to improve efficiency and capture opportunity. After 2008, global markets experienced years of low interest rates and abundant liquidity. Technology accelerated trading. Private credit expanded. Derivatives markets continued growing. At the same time, investors increasingly relied on central bank support during periods of volatility. This environment rewarded risk-taking. Strategies that performed well during stability attracted additional capital. Institutions optimized balance sheets for efficiency. Funding systems became more interconnected. The rise of complexity was not irrational. It reflected incentives created by policy, competition, and investor demand. But systems optimized for efficiency often reduce redundancy. They function smoothly during calm periods while becoming more sensitive to disruption. Over time, resilience can weaken invisibly beneath apparent stability. Markets fail to fix themselves permanently because incentives evolve faster than safeguards. Regulations often target the mechanisms of previous crises rather than future ones. Participants adapt by shifting activity into less constrained areas. This migration changes the structure of risk rather than eliminating it. For example, tighter banking regulation reduced certain forms of leverage within traditional banks. Yet leverage continued growing in private markets, derivatives structures, and shadow banking systems. Financial systems also rely heavily on confidence. As volatility declines, investors often increase exposure to riskier assets in search of higher returns. Funding structures become more dependent on continuous liquidity. Over time, assumptions formed during stable periods become embedded within pricing models and investment strategies. The system appears resilient precisely because it has not recently been tested. This creates a paradox. The longer stability persists, the more fragile the system may quietly become. Intervention can reinforce this cycle. When central banks stabilize markets repeatedly, participants may assume severe losses will be limited. This perception influences leverage, liquidity management, and risk-taking behavior. The objective of intervention is stability. The unintended consequence can be increased dependence on future intervention. Markets therefore do not move toward permanent equilibrium. They evolve through cycles of adaptation, expansion, stress, and reform. Each crisis changes the system structure, but the underlying incentives, profit, competition, leverage, and confidence, remain. A collapse typically occurs when assumptions formed during stability encounter conditions that differ sharply from expectations. Liquidity tightens. Asset prices fall. Funding becomes more expensive. Participants who relied on stable conditions must adjust simultaneously. The speed of this adjustment often reveals vulnerabilities that were previously hidden. Institutions reduce leverage. Investors withdraw capital. Credit conditions tighten. Authorities intervene to contain systemic stress. The collapse is rarely caused by one event alone. It emerges from accumulated sensitivity inside systems optimized for calm conditions. After crises, markets rebuild. Regulations change. Institutions reduce risk temporarily. Confidence eventually returns. New technologies and structures emerge. Capital flows into areas perceived as safer or more efficient. Over time, the cycle begins again. Financial systems evolve continuously because incentives evolve continuously. This is why crises rarely repeat in identical form, even when underlying dynamics remain similar. Markets do not fail because participants are irrational all the time. They fail because systems shaped by stability gradually become dependent on it. Every crisis leaves behind reforms, lessons, and new structures, but it also leaves behind incentives that encourage adaptation around those safeguards. Modern finance is therefore not a system moving toward permanent stability. It is a system constantly balancing efficiency and fragility. Understanding markets means understanding this balance and recognizing that stability itself can become a source of risk.